Trade with money you can afford to lose. This principle emphasizes the importance of using risk capital in your trading endeavors. In other words, only allocate funds to trading that you can comfortably afford to lose without significant financial or emotional distress. Here's a broader explanation. Trading involves financial risk. The value of investments can fluctuate, and there are no guarantees of profits. Therefore, it's essential to be prudent about the capital you allocate to trading activities. The money you use for trading should not be part of your essential living expenses, savings for major life goals, like buying a house or funding your children's education, or an emergency fund. Instead, it should be discretionary capital, funds you can afford to put at risk without compromising your financial stability or well-being. By adhering to this principle, you protect yourself from the potential downsides of trading. Even with the best strategies and risk management practices, losses can occur in trading. Using money you can afford to lose ensures that a losing streak won't have catastrophic consequences. It's worth noting that trading with funds you can afford to lose also helps you maintain a clear and unemotional mindset. When you're not trading with money you can't afford to lose, you're less likely to make impulsive and emotionally driven decisions. In summary, trading with money you can afford to lose is a key risk management practice that helps safeguard your financial stability and emotional well-being while engaging in the inherently risky world of trading. It's a fundamental principle for responsible trading.